If you live in Australia, you should know that you have a wonderful tool that you can use at your disposal to make you rich. This tool is called Superannuation. So today we're going to discuss how we can leverage this tool to maximize our gain. I should of course let you know that this video is for information only. It does not take account of your personal situation, and as such, you must not rush into making any hasty decision based on this information alone. If you need financial advice, you should talk to a professional instead. Now, assuming that you are a PAYG employee, every time you get a paycheck, your employer makes an additional contribution of around 11% on top of what you earned during that pay cycle. Suppose you made $100. Then your employer will make an additional $11 on behalf of you into your super account. The key to remember is that when you get taxed at a marginal tax rate for your regular earning, the earnings that you make into your super account get taxed at a concessional rate of around 15%. Now, it gets even better. Not only that your employer can contribute on your behalf, but you too can put money into this super account and still enjoy this concessional rate of around 15%. As long as this combined contribution does not exceed a certain limit. In the last financial year, this limit was $27,500. This is called concessional contribution cap. So, this 15% concessional tax rate only applies if the combined contribution from you as well as your employer into your super account does not exceed this contribution cap, which is $27,500 as per the last financial year. Now, assuming as an average Australian, you're making about $85,000 a year. Now, after you pay for the taxes and Medicare levy, how much are you going to get into your pocket? Well, your take home is about $65,000. In other words, you are paying roughly around $20,000 every single year to the taxman. See, every time you get a paycheck, guess who is getting paid? It is the taxman. Every year, we pay thousands of dollars to the taxman. And that's why you would probably be better off by putting aside some of this money into an investment fund for your own personal use into the future. But the downside is, when you are putting aside this money, when you are locking away your salary into the super account, you are doing it for a long term. You won't be able to access this money until you reach your retirement age, which could be about 10, 15, 20, 25 years into the future as you are in the job. But guess what? The reward is substantial, which we're going to discuss in a minute. So, if you take advantage of this concessional contribution cap by giving up some of your take-home salary and putting it into your super account, not only that you would save thousands of dollars every single year, which you would have wasted anyway, giving it to the taxman for your regular earnings and Medicare levy, but at the same time, it can build a substantial, let me repeat, a substantial investment return, creating a lucrative nest for your easy and comfortable retirement. Now, talking about easy and comfortable retirement, what are the official figures? Let me give you the official figures. If you are single at the age of 67 when you get into retirement, you would need about $51,000. This money is tax-free. And if you are a couple, you would need about $72,000 a year to live comfortably. Again, these are official data. And to generate this income from your investment, you would need $600,000 into your super fund if you are single, and $700,000 if you have a partner. if you are a couple. So now the only question is, how can you make sure that you have this amount saved up into your super account as you get into your retirement? Now, assuming that you are an average Australian making $85,000 a year, you are 30 years of age, single, and you saved up about $50,000 so far into your super account. Now, for your comfortable living, as you get into your retirement at the age of 67, if you rely only on this official data, luckily for you, you don't have to really worry about this contribution cap at all. You would have saved up roughly about $600,000 if you just mind your own business and don't worry about anything else. Now, in contrast, if you have a partner, you would need about $72,000 investment return every single year for both of you to live comfortably as per the official data. Now, assuming that you live up to the age of 97, for you to save up this amount of money into your super account, $700,000, you would have to make an additional $7,500 into your super account every single year until you reach your retirement age, which is about 67. Now, the good news is this $7,500 is only in theory. You would be out of pocket just over $6,000 because when you put your pre-tax dollars into your super account, you are getting taxed at a concessional rate of 15%, as opposed to getting this money into your regular bank account after being taxed at the marginal tax rate of 32.5%. Now, on a side note, I should point out that when you are getting this money into your regular bank account, after being taxed at the marginal tax rate, not only that you lose some money straight away because of the higher tax rate, but if you decide to put this money in a saving account, you should expect a return of about 4% per annum. The return, in contrast, from your super account is around 10%. So, as you get this statement from your super account, which is about 2-3 months into the new financial year, roughly around September, you should take a look if your super fund is performing around that mark, 9 to 10%. If not, then you'd be better off moving your money into a different super fund. That would be my advice. Now, going back to our original discussion of comfortable retirement, you might be wondering, well, how the heck am I going to live comfortably with only $72,000 of disposable income when I still have a partner, right? Yes, that's exactly why today we're going to do much better than that. Remember, our concessional cap is about $27,500 and we are only using up to 7.5. What happens when you max it out? Now, to max it out, you have to make an additional contribution of about $18,000. Then again, it's only in theory. In practice, you'd be out of pocket by around 15 grand, which translates to about $1,500 of take-home salary being sacrificed every single month. So now, as you can see, not only you have saved thousands of dollars of tax bill, which you would have wasted anyway, because you made this decision of putting aside 1.5 of your take-home every single month, but now, because of the return, 10% return that you earned over this substantial period of time, you have around a staggering $1.4 million into your retirement nest, even at the age of 65. But guess what? It doesn't stop there. it gets even better. Let's talk about the icing on the cake. Okay. If you decide to take your retirement at the age of 65 instead of 67, not only you can make the same amount of money as you did during your working age, you can make all of it tax-free. Why? Because as per ATO regulation, you can draw annual payment of up to 5% on the balance of up to 1.7 million and pay absolutely no tax whatsoever. Okay, no tax whatsoever for a balance of up to 1.7 million. So you have a balance of 1.4 mil, which means if you draw 5%, roughly around $85,000, the same amount of money that you made, you are getting all of it tax-free. You saved about $23,000 of tax as you make the money, and you make exactly almost around same amount of money to enjoy the rest of your life. All right, so that's the deal. If that sounds good enough, you better give a second thought to your super investment. Thank you for listening, and I will catch up with you on the next one. Bye for now.